It's not that I want you to invest in A class properties or B class properties or C class properties. What I want you to realize is when you invest in something, you have to understand how things work. You just have to understand that what your strategy is and how it operates, and don't fool yourself. It's really easy to get caught up into what people are saying. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer, and hope you're doing well. I want to talk about a couple things today. First thing is I saw a graph out there that was showing the rent growth in A class, B class, and C class properties. And what I wanted to make sure everybody understood is that history is still repeating itself. And so over the last every recession that we have data for, C class properties go down the soonest in these are rent prices, by the way, but values are the same. So they go down the quickest, they go down the most as far as a percentage wise, and they recover the slowest. And so that's been kind of history repeating itself. For some reason, in this last cycle, and maybe it happened in cycles before, I'm not sure, because I wasn't buying real estate then, but I would hear over and over again from quote unquote experts, people that would call themselves experts, or people that you would think were experts, that C class properties are the properties to buy. And they would even stay in B class to a lesser extent, but they're the properties to buy because they will stay resilient in a recession. Now, we're not really in a recession so much as we are in a oversupplied market, kind of nationwide. So these are nationwide stats. So Midwest is different, the Southeast is different. All these markets are different, but nationwide, as we put it together, we show oversupply, and then we show that C class is doing really poorly compared to A class. And so, but these experts would say, hey, when a recession hits, when we have a market cycle, what will happen is the A class moves down to B class moves down to C class, and C class, well, they have nowhere to go, so they stay there. And so you've got all these B class tenants that move to C class, and you've got the C class tenants just stay there. What I've always tried to argue is that's just not true. People don't tend to move down. They just don't. They figure out different ways to live in the housing that they live in currently. And, or maybe they move from A class to A class, but they're not going to go from A to B. And they're not going to go from B class to C class. It's just people just don't do that. They may go from a B class property in a B class location to a, maybe a C plus, B minus property in a B location or a B plus location. So somebody might, in fact, that would probably be your best opportunity, is if you wanted to say, hey, I own in a B plus class or even A class neighborhood. That's where I own, but I've got a property that was built in 1970, hasn't been updated in a long time. And so we would call that a C class property. That's the only type of movement you may see, is that somebody wants to stay in that nice neighborhood and they're willing to go with a slightly inferior property. But I think that's pretty drastic as well. I think more likely you'd go from like A plus to an A, or an A to an A minus type of thing. Statistics have shown it, and we're seeing it again. So again, I don't know where this belief came from. Part of it, I think a lot of people wanted to justify what they were doing, justify the aggressive underwriting that they had, and justify to their investors why their strategy was the best strategy. And so they just made something up that is believable. It sounds right, but in reality, it just doesn't happen. That's not what happens. And in fact, C class tenants are the ones to lose their jobs the quickest. They mostly have service-based jobs that are easy to get rid of and cut. And they'll move back with mom and dad. They'll double up. They'll do whatever because people are survivors. It's just how it is. People will survive. And so we don't necessarily gain new residents. We actually lose residents in a recession. In this case, we didn't lose residents. We just had too much occupant or too much delivery. And so the A class, which is what's being delivered, by the way, so that's the crazy thing when you think about it. The A class is what's being delivered. That's all getting absorbed. The C class is actually getting less occupancy. It's getting hurt more by the deliveries than the A class. The rents at C class are getting hurt more than the rents on the A class. So this chart showed for the last several years, and goes by quarter, and it's showing you the rents and how they're declining. And the crazy thing about it is that the rents are declining in C class and in A class and in B class a little bit, but it's always the C class that is the most by far, by a long shot. So, for instance, in Austin, Texas, A class looks like it's declining about 2.5%, where B class is declining about 5.5%, and C class rents are declining about 12%. So they are more than double the B class. And we can move on. So sorry, I said it. This is just the change in 2023, 2024. And this is for different markets. Houston, Texas, A class actually rose by about 2%, where B class declined by about 1%, and C class declined about the same. So that one's pretty similar. Sorry, no, I'm looking at that wrong. B class declined by looks like pretty much flat, and then C class declined by about 1.5%. And I can keep on going. Every market is the same. Like Charlotte, North Carolina, A class looks like it declined by. This one's actually a little bit of an anomaly because A class declined by about 2%. B class declined by maybe 0.25%, and then C class declined by about 4%. So over and over in these markets, it's the same. C class is declining the most, and it'll continue to be the same. It'll have the slowest growth percentage-wise. A class in these markets where A class is declining, it'll bounce back. It'll bounce back quicker than any of the other class. It just will. That's how it goes. B class will be next, and C class last. Now, here's why this is super important. It's not that I want you to invest in A class properties or B class properties or C class properties. What I want you to realize is when you invest in something, you have to understand how things work. You just have to understand that what your strategy is and how it operates, and don't fool yourself. It's really easy to get caught up into what people are saying. Again, like, oh, C class, A moves down to B moves down to C is going to be just great. Everybody thought C is going to be, not everybody, these people thought C was going to be great. We're going to have the best occupancy rates. We're going to have rents are going to continue to go, even when A class is getting pummeled. They're not building any more C class. They're only building A class. How many times do you hear that? But let's look at the statistics and actually think about what's real and what's being fed to you. And I think that's super important, whether we're talking about this, whether we're talking about vacancies, whether we're talking about concessions, it doesn't matter. What are we talking about? And actually look at the statistics in the history and really the reality of what takes place. And so if you're looking at this, it's still fine to invest in C-class properties. You just have to understand what you have to deal with as the market changes, right? You just have to understand that. And you have to come into that project with both eyes wide open, and you have to plan for it. There's a reason why A-class properties sell at the lowest cap rates. A-class properties sell at the lowest cap rates because vacancy stays pretty stable. Rents continue to go up, and expenses are not skyrocketing. Where C class properties, we've got more maintenance, more capex. Rents are just less stable. Occupancy is less stable. Concessions are higher. All that kind of stuff. And so it again, it doesn't make it bad. It makes it different. It gives us different type of opportunity. A class, we know we have stability, and so we know what we're buying. We know what we're getting into, which is again why the cap rates are lower. But we know what we're getting into. Where C class, we know there's a lot of opportunity for improvement potentially. There might be a great opportunity for operational efficiencies, right? There might be really good opportunity to implement good sound technology, right? But there might be really good opportunity to renovate these properties. But if we don't go in understanding the dynamics, that's where we get hurt. All right, so that's the one thing. The other thing I want to talk about is um, I saw another post today that talked about investing in your own local market versus investing out of state. And what that was saying is, look, I mean, there's truth to this. If you're investing in your own market, it's really good because you know it really well. You know the neighborhoods, you know what's going on in the market, all this kind of stuff. When you're investing out of state, so let's just say we're talking about the Twin Cities, where I'm based in, and I know the Twin Cities. I know the markets in the Twin Cities. I know the suburbs. I know inner city. I know what's going on in those markets. Um, at least so I think, and I'll talk about that in a second. Where if I'm coming from out of state, and so when we invest in out of state in, let's call it Louisville, Kentucky, we are doing a ton of research in Louisville. We're looking at the neighborhoods, we're trying to find trends, we're looking at crime statistics. We're really diving in to where we think the path of progress is, all the things that we think are important. Where when we're investing in the Twin Cities, we're doing a lot of that based on our knowledge and our feeling of the market. So when I look at that, I say, well, if I'm investing in my own backyard, it's more emotional. And if I'm investing in somebody else's backyard, it's very, um, there's a process to it, right? It's very well thought out. It's data driven. And so it gives us a little bit different understanding. So there's a bit of a competitive advantage by investing in your own backyard, but it's also easy to get stuck and not really understand what that submarket truly is, what's going on, what's truly happening in your city or cities, and where the path of progress is truly going. Are you really, really paying attention to that? Have you dug into the statistics? Have you really searched the data like you would if you were investing out of state and into a different market? I don't think so. I think most people don't do that. So that's really important to do, is to really take the time and energy and effort to really dive into your city with some blinders on and to really understand what's happening, what's going on, where the trends are, where the city is trying to put money into it. Uh, those types of things are super important. My wife and I purchased our first house in the Twin Cities in 2008. That was in St. Paul, and we're in a neighborhood that we loved. It was called, um, well, I don't know. It was the university, Summit University neighborhood, and so this was right near Dayton Avenue and Victoria. For those of you who know the market, so good, solid neighborhood. But when we talked to people, so we did our research. I looked at crime maps. I called the police officers. We saw the trends that were going on. We could see the renovations that were happening in the area. We could see new shops coming in, all that kind of stuff. So we did our research. And then, but we also heard from other people who, quote unquote, were experts. They knew the area. These are people that have lived their whole life in this area. And I remember just simply talking to my dad about it. And he's, Selby Dale. Oh, that was a bad area when I grew up. Now, he didn't necessarily pretend like an expert. He's like, yeah, when I grew up, that was the worst part of the city, right? But other people said the same thing, like, hey, that's a really dangerous area. I don't know if you guys should be buying there. And they knew, quote unquote, they knew what was going on. However, they knew what was going on 20 years ago. They knew the reputation that it once had, but they didn't know the changes that have made. And quite frankly, since we purchased there and we've sold and moved out, now it's been, oh boy, 11 years, I think. The area's gotten better, quite frankly. The new shops have came in, new apartments have came in. It's been remodeled. I just drove through the area not that long ago, and I was like, man, wow, this is gorgeous. Like there's several things that have really been done that have made it even nicer. And so the point is that local knowledge sometimes doesn't really understand everything that's going on in the market, everything that's happening in the market. And we're seeing it, in the local Twin Cities market. I mean, I was just looking at an apartment not that long ago, and this little submarket that we were looking at, a bunch of new buildings were built. This was a market rate, gorgeous apartment building. Well, when they planned this apartment building, it was a really pretty, I wouldn't call it a super nice area, but a nice-ish area that was trending upward, that people wanted to move to. And then COVID happened, the riots happened, the George Floyd riots happened, and that area became really, really bad. And it's still to this day extremely bad area compared to what it used to be. It was, I would say, trending upward. It was a nice submarket, nice-ish submarket trending upward. And so you could be local to the area. Now, I think most people know what happened in that area. So there's probably not many blinders on in that area because it was so severe of a change. But you could have some blinders on and say, oh, yeah, it's a good neighborhood. I want to be in that neighborhood. Now, quite frankly, I had a little bit of blinders on because when I saw that property come up to market, I'm like, hey, we should look at this property. Like the market's not that bad. When we went there and I drive down the freeway or drive down the freeway and go on the off ramp, and there's a guy on the off ramp that's high as a kite that's yelling and dancing in the middle, and then you go under the bridge and there's people shooting up drugs and there's prostitutes everywhere, and you go and view this beautiful building and get out and you're talking to the construction workers that are right there, and they're like, this is terrible, this is unreal how bad it is around here. People find needles all over all day, and you see what's going on, and you realize, okay, things have changed in this area. I knew change had happened, but this is severe change. So I guess my whole point for this whole thing is when you're investing in your own backyard, treat it like you don't know much about the market. Really do your data research. Uh, Use your own backyard as a massive strategy, like a massive benefit, right? Because it is like investing in your own backyard is a massive benefit if you do it right, but it's easy to do it wrong. So don't do it wrong. Take your time and actually do the due diligence. We've invested out of state and we've invested in our own backyard, and I will say it's definitely much easier. It's a big advantage. When you're investing in your own backyard, I can go run to a property. We got something going wrong. We got something. We got to meet somebody somewhere, sometime, whatever. We can go run there. We had where we had somebody quit, and one of our other staff was on vacation, and so my business partner ran down to the property, and he actually worked at the property for the day. He did some showings, he took some tenant calls, worked on everything he normally works on, but um, he was able to run down there, and it was really simple. Now, that's not long term permanent, but had that happened in Lexington, Kentucky, for instance, it would have been much more challenging to go run down there and take care of those things than it is in your own backyard. Same thing with, um, just doing a showing last minute. Like this property last week, we went and saw it. We weren't planning on seeing it. And the broker just calls us and says, hey, can you come see it? And we're like, yeah, I actually could go over there today if you got opportunity. And so we went over there about an hour after they called and toured this property and put an offer in that same evening, right? That just wouldn't happen if it's out of state, right? You can't go to the local
events that the brokers are hosting or any vendors are hosting. It's just a lot harder. So there's a huge advantage of being in state, but again, treat it like it's out of state, like you know nothing about the market, and you'll learn a ton more. That's all I got for today. You have a fantastic rest of the day. Make every day a Saturday.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.